Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for Q2 2018. My name is Nicholas Basso, and I'm a Portfolio Administrator in Ironwood's Asset Management Division. Tonight, it's my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions during the presentation, please feel free to type those into the chat box, the GoToWebinar tool panel on your screen. I'll compile the questions, and we'll do our best to address all of them at the end of the presentation. And now, without further delay, let's welcome Sean, our featured presenter, to the floor. Sean, please take it away.
Thanks, Nick, and thank you everybody for joining our call tonight. The last two phone calls we've had both in November of last year and February earlier this year, the S&P 500 was at 2580, and this morning as we came into work, I was fearful that we were going to be around 2580 again, but the market turned around. So fortunately, we can continue to have this call, because if we were going to be at 2580 again, I was going to have to skip one of these calls to see if it was our doing or not. only kidding a little bit there. But anyway, the market over the last 6 months since November of last year, the S&P 500 is only up about 2%. The ride we've taken to get here has not been an easy ride. It's been very choppy. There's been a lot of news, a lot of things happening. So we're going to try and clear some of this up and try and keep it fundamentally based and fact based. But we're going to go ahead and dive into the slides today. Like we always do, we're going to cover the global economy, and as the slide says, the expansion continues. So we'll talk about that. We'll dive into the U.S. economy. We'll look at central banks and interest rates. We'll take a look at earnings, and I think the biggest part of this call is kind of show some earnings estimate changes and how that's going to impact things going forward. Fundamentals of a prudent portfolio, and then we'll let history teach us some lessons. So we'll kind of go through each of these areas. So the global expansion continues. In February, we had a PMI number for the globe of 54.1. Anything over 50, we're in expansion. So you can kind of see here with the chart, we've taken the numbers out, and we can kind of see green is good, red is bad, yellow is in the middle. So you can see here is where the financial crisis happened. A couple of years later, Europe had a double dip recession because they started tightening interest rates a little too soon. And now, for the most part, the developed world is mostly green. Emerging markets are improving. You've got almost every single country that's over 50. And then you've got, these are March numbers, but March was 53.4 for the global PMI. Like I said, 54.1. And then April, which isn't on this chart, is 53.5. So those are good numbers. Growth is not slowing. Yeah, maybe it's a little choppier, but things are going well. We were at 51, 52, so to be at 53.5, 54 the last 3 months, those are very positive numbers. This shows us that the global economy is still humming along pretty well. The U.S. economy is doing very well as well. If we look at leading economic indicators, yeah, they're not as strong as they were at the beginning of the year, but they're still pretty strong. We've got the 10-year Treasury at the end of the quarter. It was at 2.74, but as of the end of today, it's up 21 basis points since then. So it's at 2.95. And actually, we broke 3%. We got to 303 on the 10-year Treasury about a week or so ago. So we'll want to continue to see that. That's exactly what we've expected as interest rates have to continue to go north. ISM manufacturing and non-manufacturing, although they've slowed a little bit from their vigorous pace at the beginning of the year, they're still doing very well. On Tuesday of this week, ISM manufacturing came in at 57.3. Once again, anything above 50, and we're expanding. And then this morning, ISM non-manufacturing came in at 56.8. So those are a little slower than the beginning of the year, but they're still very strong numbers. And if we look at the jobs market, the economy added 200,000 jobs on average in January, February, and March. The unemployment rate stuck at 4.1%, and it's still there. Tomorrow we have a new jobs report. One of the items that a lot of folks are going to be looking at is wage growth. One of the wage growth last month wasn't as robust as we would have liked to see. It was year over year up 2.4%. But the labor market definitely is tightening, and we expect that wage number to continue to increase. We've had the lowest claims, initial jobless claims, have been the lowest since the late 60s and early 70s. We've seen 161 weeks in a row that initial weekly claims have been under 300,000. That's the longest streak since 1970. So the job market is very strong right now. Real GDP for the first quarter, the first estimate was 2.3%. We expect 3% for the year. We've kind of seen this trend over the last couple of years where the first quarter GDP is a lot slower than the remaining 3 quarters of the year. So 2.3 was actually analysts were expecting 1.8, and we got 0.5% better than what analysts were expecting in that preliminary estimate. So we expect stronger numbers the rest of the year, and we're thinking that 3+% GDP growth for 2018 is a possibility. The expansion now is the second longest expansion that we've had in U.S. history. Now, remember, when I talk about expansion, that's looking at GDP, and it's looking, expansion is when we're growing GDP. As soon as we have 2 quarters of negative GDP growth, that's the definition of a recession. We haven't had one of those. It's been the second longest in 105 months. And if we continue to grow, which we anticipate, it's very hard to paint a picture with the tax changes and with some of the deregulation. It's very hard to paint a picture where we see negative GDP growth through 2018. So if we make it to July 2019, which I think it's not a slam dunk, obviously, but I think there's a real high chance of us making it to July 2019. If we make it to July 2019 without 2 quarters of GDP growth that are negative, it's going to end up being the longest recession that the U.S. has ever seen. Now, with that said, you can see that cumulative GDP growth it's not even comparable to some of these other expansions in the past. So although in length and time has been 105 months thus far, the cumulative GDP, still, you can make an argument that we could go a lot. We haven't really had robust GDP growth. You haven't seen that vicious turnaround from the recessionary period that we had. It's been a slow sludge of growing. which isn't necessarily a bad thing. It means that this could be the longest, and we could still have, if we get a couple of years at 3% GDP growth, maybe this blue line starts to catch up a little bit before we end up having negative GDP growth. But even though length of time, it seems like it's been a really long time, you have to look at the growth and where we are. And I don't think that it necessarily, just because the length of time is one of the longest we've seen in history, I don't think that necessarily means that we're imminently ready for this thing to be over. So that's GDP growth. That's more economic looking. If we look at the stock market, you get a completely different picture. So if we look at the stock market, we just take the S&P 500 and we say, okay, the last 10 bull markets, where do we fare? And you can see that in duration, we're only number 4 right now out of 10. At a price gain, we're 6 out of 10. PE at peak, we're 6 out of 10. So all of these just say we're basically average for a bull market. This is an average bull market thus far. 109 months, 260%. The average, 93 months. So yeah, we're a little longer than average, but price gain, we're right almost exactly at the average, 259, 261. So this thing doesn't necessarily have to be over. We could still, this bull market could still last a lot longer, and the price appreciation could be a lot more. PE multiples. I want to touch on PE multiples again today because of the tax change and because of how impactful that's been on analyst estimates, and what a significant change we've seen over the last couple of months with both the price of stocks. Stocks, in February came down 10%. But also what happened was analyst expectation for earnings jumped significantly. So you've got two things that dramatically bring down your price to earnings multiple. So I just did an example here. Right now, the 2018 earnings estimates based on Thomson Reuters and S&P data is it's a little less than $159 a share. I rounded up. $159 a share for S&P earnings. The current S&P price is right around $26.25. So if we were to do price, which is $26.25 divided by earnings, you get 16.5. Just to give you an idea, last time, well, I shouldn't say last time. Early this year, we were at about 18.5 to 19 times on a multiple, and we were becoming more concerned with an overvalued U.S. market. We were planning on doing a rebalance when we hit 20, a PE multiple of 20. We never really got there on a forward-looking PE multiple, and so we never did a rebalance. It would have been great to do a rebalance in end of January before the market pulled back 10%, but unfortunately, you can't always time these things correctly. But looking at it right now, 16.5 multiple, all else being equal, but still, even though interest rates are higher, they're still low. You could make an argument that 16.5 multiple is an attractive place to be from where we are right now. So we talked about some of this stuff. So one of the things I wanted to point out here, this data is analyst expectation. I really want you to pay attention to two things. One, this right here. So this is showing analyst expectations of Q1 earnings over time. So you can see in Q1 of 2017, this is where analyst expectations were at $34 about for Q1 of 2018. And you can see the analyst expectations changing over time, okay? So so this is Q1, Q2, Q3, Q4 of 2018. You can see all four of them jumped up dramatically right around the end of the year. Well, guess what? That was everybody recalibrating because of the tax change. So you've got an increase in earnings, significant increase in earnings, and then you actually get earnings coming out in the first quarter. And thus far, earnings, a few days ago, we had 300, I've got data that's a couple days old, but we had 319 companies that had reported, which represented 76% market cap of the S&P 500. So 3/4 of the S&P 500 represented in this data. 81% of those companies beat earnings estimates. That's a very, very strong number. And then 67% beat on revenue estimates. And these are estimates that had been increased due to the tax reform, and then increased again when earnings started to come out. So analysts are realizing that maybe they got the tax reform wrong and things may be looking better than they thought, and that's why they're increasing their earnings down here for Q1. Approximately 29% earnings growth year over year is what this represents. So that's a giant number. 29% year over year earnings growth, that's huge. And then approximately 8% revenue growth, which is also a very substantial number. So these tax changes definitely have improved numbers. It's just a matter of, is it going to be something that just is positive for a very short period of time, or does it extend over a couple of years, and do we really see GDP growth sustainable at 3+%, or will we get a pop that goes 3+% for 2018, maybe a little bit of 2019, and then a reduction and maybe a recession in 2020? That's really the ultimate question, and there's a lot of things that play into that. So when you have a dramatic increase in earnings estimates and a 10% pullback in stocks, well, those things both decrease your PE multiple. And as of this is the end of April. As of the end of April, we had a forward-looking PE multiple of 16.1. You can see that significantly dropped. That dropped 2 points, 2+ points in a very short period of time. We went from being what I would call overvalued to fairly valued in a very short period of time. And the beauty of it was that we only had to go through a 10% correction to get there. This could have been a lot worse had expectations not gone up as much as they would have. Okay, so we can look at different valuation metrics. The last 25 years, 16.1 has been the average PE multiple. We're at the average, so we're under or over the standard deviation. We're right at the average. The Case-Shiller PE multiple, 26.6 is the 25-year average. We're a little overvalued if you look at the Case-Shiller, but that's looking backwards, not a really good indicator, especially with the tax changes. So that's not the best indicator, but even then, we're less than one standard deviation above average. If we look at dividend yield, 2 versus 2.1, we're undervalued. Price to book, fairly valued. Price to cash flow, a little overvalued. And then earnings spread, we're undervalued still. So just it dramatically, the estimates dramatically changed the attractiveness of the domestic stock market, and also spilled over to some of the international markets as well. And why is PE multiple so important to us? Over the short run, they're not very important to us. This is a scatter plot of 1 year returns after a given PE multiple, and you can tell There's no rhyme or reason. This is not clustered. It's random. They're all over the place. So PE multiples don't give us a lot of clarity on what's going to happen over the next 1 year. But if we say, okay, let's look at PE multiples and let's look at the stock market and its performance over the next 5 years. So that's this chart over here. We get a much better regression analysis when we look at 5-year returns, and we get a better idea. When the PE multiple is lower, you end up usually with a higher return over the next 5 years, all else equal. And so it's just it just tells us that future returns are probably a little better than they were at the beginning of this year, or at the end of January when we had 19 multiples, which makes sense over a longer period of time. Unemployment, like I said before, we have a tight labor market. We'd like to see this wage growth tick up a little bit more. Year over year, in March, it was 2.4%. We'd like to see that a little bit better. One of the things that makes me think that it's going to be better is we look at the Atlanta Fed. They track wages a little bit different. They kick out folks who haven't been in the workforce for over a year, and so you tend to get a little bit better, a better representation, in my opinion. And if you look at the Atlanta Fed wage tracker, it's up 3.3% smooth, and they have a March reading that's unsmoothed at 3.9%. So March ticked up dramatically for their readings. So I'm going to be watching that when we get the new data here to see what's going to happen with wages. And why wages are so important is in a tight labor market, wages tend to go up, and wages tend to cause some inflation, and the market's going to be looking at that because the Fed is going to be looking at that, and they're going to be, that's going to help them determine interest rate policy over the coming months and years, and that's why that number has been so important. Cyclical sectors, they all look good. I'm not going to spend too much time on this slide. They look pretty good. One of the things I also want to touch on when I'm on this slide is small business optimism index. I don't have it on here, but it hit the highest level in 35 years. So you add optimism from small businesses plus the tax cut, we could see some CapEx spending going forward. Since we've got high optimism, we've got some cash flow positive things with the tax cuts, so that might spill over into some more capital expenditures. Consumers, I'm not going to spend a lot of time here. You guys get it. Consumers are doing really well. We've got about $7.3 in assets to every dollar in liabilities, and most of those liabilities are mortgages. Household debt service, it's ticked up a little bit because interest rates have gone up, but it's still at pretty low levels compared to recent history. Consumer net worth, household net worth, it's gone up dramatically since 2007. If we were to look at real household wages, we're back above numbers that we've seen, that we haven't seen since 2000 and 2007. So people are actually making more on an inflation adjusted basis than they were in 2000 and in 2007. So we're starting to see consumers really do well in this environment. Federal finances, I haven't had this slide in here for a while. I thought I'd add it because this tax plan, it's kind of a strange time to have a tax plan when the economy is doing pretty well. The Fed is starting to want to tighten, and then you have the government adding fiscal stimulus. So it's a little counterintuitive, and the tax package. I think you got a lot of people who agreed that we need to lower the corporate rate from 35 to 20, 21. They ended up with 21. But the big personal cuts and the total package of $1.5 trillion over the next 10 years, definitely we're going to want to keep an eye on this. And we can't tell you what's going to happen. All I would say is if we end up, this is the CBO baseline here, if we end up with debt that's almost 100% of GDP, so this is assuming some pretty lousy GDP numbers. The CBO is not really giving too much credit to the tax plan and actually boosting GDP growth. You can see real GDP. Yeah, they have it at 2.1% in 2017. Well, that's pretty low. 2018, 2019. Well, we had first quarter at 2.3 so far, probably closer to 3% for 2018. So these are probably pretty conservative numbers. So it depends on does this tax plan boost GDP and do we earn more in taxes because of that, or do we end up on this trajectory where GDP, or I'm sorry, where debt ends up being 97.5% of GDP? If that's the case, and I think the only real way to plan for you can't control any of this, but what you can plan for is you can plan for higher taxes later, which is probably a good way to plan, and then possibly higher Medicare, higher or higher taxes on Social Security. Those benefits that costs, the biggest items for the federal budget are Social Security and Medicare. So cuts in those two areas and higher taxes are the easiest way for the government to handle this situation. So if in your mind you're just thinking, okay, well, in the next 7 years, if taxes are good, maybe we should make some decisions now so we can control our taxes and our incomes later, so maybe we don't get hit as much in some of these other areas. One of the things that I hear a lot with Social Security is, okay, are they going to means test it? So if somebody's got income above a certain threshold, they're going to get a reduction in their Social Security payment. Those are types of things that I could see happening should we not get the growth that the administration is hoping for, and we end up with a debt level that is close to 100% of GDP. So just things to keep in mind. We can't control any of this. This is the big argument: is will some of these tax cuts lead to higher growth, and will we grow our way to not be in the situation that the CBO is baselining here? And that's ultimately the question, and nobody knows the answer, and we'll have to figure the answer out as we go. International markets are looking pretty good right now. The global reflation is definitely happening. You can see global GDP has ticked up to 5.7%, and you can see typically what happens is when you have a GDP that ticks up, you usually see earnings that follow. So we've had GDP tick up here, and we've had earnings. It's still going up, so we expect earnings to continue to follow up. Europe is very strong. It's probably one of the strongest areas. If we went back to the PMI chart, you'd see some of the highest levels. The greenest of that chart are some of the countries in Europe. They're a couple of years behind us because they went through a recession, and then they started to tighten rates, and it caused another recession here. So you see negative GDP growth, and they're out of it. The U.S. never tightened rates. The Fed continued to loosen rates, and then they did QE1, QE2, QE3, whereas Europe finally decided, okay, we're going to follow the United States game plan, but they did it a little later. So Europe is a little bit behind, so I think there's some potential for some more growth outside the U.S. and in particular in the Eurozone. I see as one of those areas that's a bright spot. Now, that aside, we also have seen in the past where you have periods of time where the U.S. outperforms outside the U.S., and then you have outside the U.S. outperform the U.S. And over the last 40 years or so, it's been, so we'll just go through this really quick. We had 2.5 years where international outperformed the S&P 500 by 80%, followed by 3.5 years where the S&P caught back up or outperformed international by 28. Then you had international outperform in 2 years by 89, S&P up by 51. Then you had a huge run up in international, 374% outperformance in 6 years. If something like this happens, we definitely want to make sure that we have some international exposure in the portfolio. You're not going to want to miss out on 374% in 6 years. Now, that was followed by the S&P 500 outperforming international by 100%. So a little bit of a catch-up there. But you can see, we just have periods of about 5-6 years where it goes domestic, international, domestic, international, domestic for 9 years, 86% outperformance. The last year, international has outperformed domestic by 4%. Now, will that continue? If we look at this chart, we make a good argument. But we don't want to just look at this chart. We want to look at other things. And when we look at valuations, valuations look a lot better as well. Let's look at the S&P 500 versus the global stock market ex-US. You can see the PE multiple of outside the United States is currently at 13.3. The 20-year average is 14.5. So that tells me that compared to the last 20 years, outside the United States, people are not paying as much as they have in the past. So there's probably some undervalued component there. And then if we look at dividend yield, the 20-year average is 3. We're getting 3.3. So we're getting 3.3% dividend yield in our international play, and it looks more attractive. That's definitely going to be a place that we're going to want to put some emphasis in the portfolio versus the S&P 500, where its 20-year average is 16 times, P multiple 16.4. Okay, you're fairly valued. We already kind of went through that. 2.1 versus 2. Yeah, it's right around its average, right around fairly valued. Then you throw in the fact that if we look at this international index, ex-US, its price level isn't even to where it was back in the crisis, whereas the S&P 500 is significantly higher than it was pre-crisis. So these are some of the reasons that international looks very attractive to us. Central banks and interest rates. So this is just the 10-year Treasury, and you can see that we've had about a 40-year bull market. Now, you can see a couple of times when it goes up. This last time, it's been pretty significant upward trend here. We're talking highest levels we've seen in almost 10 years. Depending on what you're looking at. But you can see we're heading in that direction. Now, is this the end of the bull market? We don't know. We think that 10-year Treasury rates are headed to 4-ish%. We've managed the bond portfolio to not be as interest rate sensitive, and we're very happy that we have been like that the last month or couple of months because of this run up. But the 10-year Treasury 2.95, and a couple weeks ago it was at 3.03. So we've definitely seen an increase. We still expect 3 more rate hikes from the Fed for the remaining part of the year. So the bond market is definitely one of the hurdles that we have in front of us, and it's one of the reasons that we think that even though earnings have gone up, earnings expectations have gone up about 30%, the stock market's gone down 10. We think that this is a big hurdle or headwind in front of the stock market, but those earnings going up 30%, and the stock market only coming down 10, it could have been a lot worse had those earnings expectations not gone up as much as they did. So this is definitely an area we want to watch. We don't want huge increases in the 10-year Treasury, but a lot of our clients are retirees. If you look at the income flows in the United States, it's about $1.4 trillion that investors earn from interest rate increases, or that's what they're earning in income. So as those interest rates go up, that 1.4 trillion goes up versus, so 1.4 trillion on the income side of things versus 350 billion in interest expense. So yeah, if interest expense goes up a little bit, but that's a smaller 350 versus 1.4 trillion. If they go up percentage-wise the same, the income is much greater than the expense. And so that's going to help. That's going to help retirees. It's going to help pension funds. It's going to help many investors with their bond portfolios and actually earning a little bit better interest from the safe parts of their portfolios. So this chart here I've had in the last couple of slides. I think it's really important because I think it talks to this interest rate conversation that we're having. So we're in the second quarter of 2018 now. So right now, the Federal Reserve is getting rid of $30 billion per month of bonds. They're reducing the balance sheet by $30 billion per month. In the third quarter, they're going to reduce that by $40 billion per month. And by October of this year, every month, there's going to be a reduction of $50 billion per month from the Fed's balance sheet. So that's going to end up, so come October, which is not very far away, 5 months from now, it'll be October 1st, and we'll be in the fourth quarter, and the Fed will be reducing their balance sheet by $50 billion per month. That's $600 billion per year. And they're going to reduce that balance sheet. So you better believe that this is going to have some impact on bonds and bond rates. So we want to definitely be cognizant of that. Now, just because the Federal Reserve is reducing the balance sheet, increasing interest rates, doesn't mean that all the central banks are. You can see here we're in 2018. This orange bar here is the additional stimulus into the global financial system, the monetary system. So you can see we don't get to zero until 2019. So that means that in aggregate, central banks are still easing, and they will continue to ease until 2019. The only bank that is not easing is the Fed, and you can see that by the reduction here. But in 2019, you can see that we have a net reduction, and we continue to have a net reduction. So over the next 6-12 months, it's going to be very interesting to see how the bond market reacts. And you can see that this corresponds with cuts and hikes. The last 2 years, we haven't seen a single cut in interest rates. We've only had hikes, whereas in previous years, we've had plenty of cuts. So this is all I'm trying to show here is that global monetary policy is still easy, but it's heading in the other direction. It's not becoming more easy. It's becoming less easy. And at some point, it's going to actually become tighter. And that time, we think, is right around 2019. So this is the yield curve as it was March 31st. It hasn't, everything's bumped up a little bit because this 2.7 is now close to 2.95, 3 percentage points. But the shape of the curve is still very similar. Why is the shape of the curve important? The shape of the curve is important because when we have an inverted yield curve, which means an inverted yield curve means that these shorter term rates go above these longer term rates. So you can see in 2013, we had a very steep curve. This is a steep curve. In 2018, we have a pretty flat curve. It's not flat, it's not inverted yet, but we definitely want to keep an eye on it because the past couple times we've had inverted yield curves. So it happened in the late 80s. A couple years later, we had a recession. It happened in the late 90s. A couple years later, we had a recession. It happened in the middle of 2000s. A couple years later, we had a recession. So this is something that a lot of people are watching, is the 2-year minus 10-year spread. Right now, it's right around 50 basis points. That's definitely something that people are watching. Fed expectations. This just shows the dislocation between what the Fed thinks, which are the blue line, versus what the market thinks. So the Fed is expecting more rate hikes over the next couple of years, and the market is expecting they're actually going to hike. What we've seen is over the past couple of months, as the Fed has actually been hiking, these two lines have been coming together. They used to be even more dislocated than they are. They've been coming together, and interest rates have been increasing. So just something that we want to keep an eye on. And if we think that we're going to be in an increase in interest rate environment, which obviously, you know, our thoughts, we've been saying it, I think now for 4 years. If we think we're going to be in an increase in interest rate environment, we want to know what kind of bonds we own, because each bond is going to react a little bit differently. If we have a 1% rise, so we're at 2.95% on the 10-year Treasury right now, let's just pretend that tomorrow that goes to 3.95. It's not going to. That's a huge move in one day. But let's say over the next year it goes to 3.95. If we hold 30-year Treasuries, that is going to equate to a price movement of negative 17% in a bond. So that's a huge move, a negative move in a bond should interest rates rise 1%. If they rise more than 1%, well, then you're going to have more than a negative 17% reduction in the value of your bond. So I don't necessarily like to look at the 30-year, because that's you know, looking long on the curve. But if you just look at the U.S. aggregate bond index, if we increase over the next year, we go from 2.95 to 3.95, which I think is a very probable, very realistic scenario. That means our bonds are going to lose about 6%, and we're going to earn about 3% in income. And so we're going to have a negative 2.8% total return if we hold bonds over the next year and interest rates go from 2.95 to 3.95. Okay, so not a very attractive place to be. Now that doesn't mean we want to just get rid of bonds. Bonds have a place. It's if something happens that we don't expect and we have a recession, well then bond rates might go down. Stocks would go down, and you want something in your portfolio that's going to earn income and act differently or opposite of stocks. So it's not that we want to get rid of bonds, it's just maybe we decrease our exposure to bonds. Now let's look at fixed income, and let's look at global fixed income. You can see the U.S. aggregate. As of the end of March, it was earning that the yield on that was 3.12%. If we look outside the United States, because remember, the Fed is tightening, the Fed is decreasing its balance sheet, increasing interest rates. So the U.S. has a lot higher interest rates. Outside the United States, the global ex-U.S. aggregate, the yield is just over 1%. So like I said, outside the United States, everybody's a couple of years behind us. And so it lends to different investing strategies when you're looking at different areas. So I just wanted to point that out. So how do we navigate? How do we get through? You know, as a portfolio manager, in times when asset prices are dislocated, like 2009, when people are selling based on emotion and price to earning multiples are less than 10, and when you look at bond default rates and recovery rates, and you imply Great Depression type scenarios, and you can get a 45% return from a bond fund over 5 years, even if you have Great Depression type scenarios. Those are easy times to be a portfolio manager. They're very difficult times to manage clients because unfortunately that means the assets are at low levels. But it's very easy to know what to do. In times like this, where asset prices are fairly valued, and it's a little bit more difficult to know kind of where to put some of the portfolio, where to overweight and where to underweight. It's a lot easier to handle, to deal with clients and to have meetings because most people are happy. Their portfolios have done well, and but it's kind of reversed when you look at the portfolio. So we go back to fundamentals in times like this. So one of the fundamentals is looking at cash. So just to put this into perspective, there's $15.7 trillion of U.S. cash laying around. That's more than consumer spending for the year. And if we added up all the mortgage debt, we could pay off all of the mortgage debt and still have money left over. That's how much cash is on the sidelines. And as of 2017, cash wasn't paying that much. Now, because of interest rates increasing a couple of times, we do see cash starting to pay 1.5%, 2%. Getting close to that 2% number. So there will be an alternative. But over the long run, if you need your portfolio to earn a hurdle rate of X percent, it's going to be very difficult to earn that unless you have a ton extra in your portfolio if you have a substantial amount in cash, because it's just not going to, over the long run, it's going to give you a lower return. It's going to give you great safety, but it's not going to give you a great return. So another chart here that really changed a lot since the last time we talked because of those earnings estimates is this relative strength. When we look at the S&P 500 earnings yield, which is just the inverse of the PE multiple. So we're kind of looking at the S&P almost like a bond. And this chart here, when the S&P 500 earnings yield is below the bond rate, the Moody's just above or just below investment grade bond rate, that means bonds are more attractive than stocks over here when this blue line is above the green. But as soon as the green line is higher than the blue line, that means stocks are more attractive than bonds. And yes, we did see rates come up, but we also saw earnings expectations go up. And even though the rates have gone up, they haven't gone up as much as the earnings yield. So stocks actually look more attractive now than they did before these earnings estimate increases. Just to give you an idea here and how big that earnings estimate jump was, this Q1 this is with some of the data in. So this is not really an estimate. This is with a lot of the companies that have reported. 65% of the companies have reported in this number, and you can see what a dramatic jump that is. And they, earnings estimates obviously expect to increase over the year. But if these numbers come true, we're going to have earnings that are, 159, 158, 159 for 2018, and that's going to, if prices don't go up from here on the S&P 500, that's going to create a scenario where the market looks a lot more attractive than it did. I'm going to skip that slide. I'm going to skip this slide today too. Commodities. Commodities is also another one where finally we're starting to see some benefit in owning commodities. It's one of the better areas thus far in 2018. It's been one of the better areas. And one, we still have low prices, so commodities are definitely a good addition to a portfolio. They're a lowly correlated asset, so we definitely want commodities in a portfolio. If we can get a low correlated asset that has a positive expected return, adding those assets together is very beneficial for your portfolio. But with these inflation expectations that have increased, commodities tend to be positively related to inflation. And you can see that down here in the bottom right chart here. And as in the headline CPI goes up, so do commodities prices. And if we look at the TIPS market to give us an expectation or kind of an idea of what inflation expectations are, you can see that currently the inflation expectations implied by the TIPS market are about 2.2%, which is the highest we've seen in 4 years. So we're pretty optimistic about commodities, and we think that might be one area that shows some positive growth here in the short term. Importance of having some bonds in the portfolio, I kind of already talked about it, but this is a graphical illustration just to show us why it's important to have bonds. So if we were to take $100,000 in 1998 and we were to have 40% in bonds and 60% in the S&P versus just all in the S&P, you can see that over this time frame, it's 20 years. And the S&P 500 had much lower levels in some of these recession periods and bear markets, and it's just now crossed over from the 60-40 portfolio. So you've taken a lot more risk, you've had a lot more volatility with the S&P 500 portfolio, only to end up with a little bit more money at the end. So it's a matter of what your time frame is, but it just gives us an idea of why bonds are so helpful to have in the portfolio, because they really reduce those big losses that we see in the portfolio, and they allow us to rebalance and use some assets that maybe have done well in periods like this to buy S&P 500 or other aggressive things that have really taken it on the chin. Holding period returns. This one is something that I think everyone needs to tell themselves every time they're trying to figure out, okay, well, what type of return should I get? Well, if we're talking about living expenses or a purchase that we're going to need in the next 3 years, well, 1 year period or 5 year period, 1 month periods, you can see the longer you give your stocks, this is showing stock returns. And if we're looking at a 1 year time frame, 75% you made money on a 1 year time frame. Well, that means 25% you lost. So if you have a purchase and you know you need the money in 1 year or less, you probably shouldn't be putting the market in or money in the market, because there's 25% chance you're not going to have the same amount of money you started with. You're going to have less. So you need to make sure that, okay, is it something that I could be okay if I only had if I had less money than I started with? Well, 5 years, you're at 90% of the time you had more than you started with, but still 10% of the time you're with less than what you started with. So not until we get to 10 or 15 years do we really get the benefit of holding those more aggressive assets that over the long run give us a higher return, but over the short run, you may or may not make money with them. So 10 year, you get 97% of the time you make money. And 15-year, there hasn't been a single 15-year period where the S&P 500 has lost money. So that really helps to build a portfolio and to know, okay, well, if I need money in the next 3 years, 4 years, 5 years, I better have some safe assets to go to in case it's a 2008, 2009 scenario where my equities are going to take it on the chin. This is very similar to that last one. It just shows 50-50 portfolio. So if we had a 50-50 portfolio versus just an all bond or all stock portfolio, I can sit here and say that over this 70-year period of time-ish, a 50-50 portfolio never lost money over a 5-year rolling period. So somebody who had a 50-50 portfolio versus all stocks, they have a lot better outcome when it comes to, okay, in 5 years, if I need this money, a 50-50 portfolio, the worst I've ever done is 1%. So that's why it's important to have that diversified, have some aggressive, some safe assets in the portfolio so that we know that no matter what happens with the market, we can't really control that. What we can control is we can control our allocation, we can control our spending, and we can control how we build that portfolio to match up with our cash flows. This is a nice chart to put in here, because over the past couple of years, we literally went about 2 years without a 10% pullback, because this 11% pullback actually happened early in 2016, and then we finally had a 10% pullback. So we were warning about it last webinar when we were building the webinar, and then before we could actually have the webinar, we actually had one, and we were talking to you guys after the 10% pullback, so it didn't really help all that much, but we had been saying it in previous webinars up to that point. The previous 16 and 17, guys, we can't expect the market to be like 16 and 17 because those were anomalies. Those were stair step up and to the right with where the markets went, and that's not normal. You can see what's normal is if we look at the S&P 500, normally it has a drop of 13.8% on average, even though 29 out of 38 years end up positive. You end up with in the middle of the year, you end up with a pullback of almost 14%. That's normal. So 10% pullback in a year, that's normal. That's something that we should expect. And we kind of got lulled to sleep over the previous 2 years because we hadn't had one for 2 years. So just wanted to point that out and to make sure that this kind of goes along with having the right time frame. So now, how do we put it all together? Well, we want to make sure that we have a diversified portfolio. A diversified portfolio, this asset allocation portfolio is a hypothetical diversified portfolio. It's never the top one. It's never the bottom one. If you're a golfer, it's right down the middle. You tee it up and you want to make sure that you're right down that fairway. And it's always right down that fairway. Sometimes it does better, sometimes it does worse, but it's one of the ones that seems to be always in the middle. Over the since 2003 to 2017, the asset allocation portfolios are 8.3% annualized. And then the other thing, everybody worries about, oh, what was my return? What was my return? What was my return? No one ever asks, what's the risk that I took to get that return? And that's a very important question, because just telling you what your return was for the year, that doesn't tell the whole story. You have to know, well, what was my standard deviation, which is a measure of volatility? What was my risk? What was the risk that I took? And you can see that 8.3% return with only 11% standard deviation. That is a good spot to be in versus some of these other ones that maybe, developed markets, they earn 0.3% better, but they took a lot more risk. And so that's what diversified portfolio is all about. It's about putting things together in a certain way so that you can reduce the risk of the overall portfolio without giving up a ton of the return. Okay, with that said, not a lot's changed with our investment implications, because when it's all said and done, November we were at 25.80. International markets were very similar. The only thing that's really changed is bond rates are higher, and so that's kind of what we expected, and we expect bond rates to continue to go higher. So not a lot of the investment implications have changed. We're still fans of commodities. If you pushed us, we'd be in favor of developed international and emerging markets, so outside the United States versus inside the United States. Instead of we'd underweight some fixed income, especially long duration fixed income, and to make up for that, we might add some to market neutral, which is a less risky area to be in, but gives you a similar return profiles as fixed income, but without that interest rate risk. And then once again, we still favor small caps over large caps, and then two interest rate plays. We've seen this come to fruition as interest rates have increased. REITs and utilities have just completely underperformed other areas, and we still have exposure to those, but REITs, most of our portfolios have about 3% in REITs, and that used to be 5 or 6%. And utilities, we have 2% in utilities, and that used to be higher than that. So these are areas that we don't want to get rid of. We always want pieces of asset classes in the portfolio. We just might not own as much as we normally would. So with that, I'll open it up to questions, and Nick will gather them together, and then he'll go ahead and ask some of those questions.
Thanks, Dean. The first question that we have here is with regard to the trade wars that we're hearing about on television between China and the U.S. Generally, what's your take on this topic, and how do you see this impacting maybe some of the technology companies that are more well known, I guess we'll say, in the U.S. or just in general?
So I'm a free market guy. I don't necessarily agree with the tariffs. I understand why the administration is implementing the tariffs. It's a negotiating tactic, and I think that that's really what it is. I'm not too concerned with the tariffs because I think push comes to shove. I think there are enough people in the administration who realize that free markets are where we need to be for the most part, and the tariffs are more of a stick and trying to get folks to play nice. I think China has for years taken advantage of the United States with intellectual property and other things, and I think that this is an attempt to try and get them to play nice. They're going to be the largest economy in about 10 to 15 years, and we're gonna not want to be in a tit for tat with some of these countries. So yes, I'm keeping an eye on it, but my thoughts are, and what we've seen thus far is it's more of a negotiating tactic than a permanent market disrupting issue.
Okay, I've got another question here for you. This one's pretty straightforward. Where do you see the 30-year mortgage rate in the next 6 months? or the long-term treasury, essentially?
So I was looking at this the other day. I'm going off of memory here, but the 30-year was like 4.53 the other day when I was looking at it. I would imagine that if bond rates go to where we think they're going to go, the question was over this past the next 6 months, Nick.
Yes, end of the year, let's just say.
So let's say by the end of the year, I wouldn't be surprised if the 30-year mortgage is closer to 5%, and 4.5%, where it is now. And I think that could be a headwind, and that's one of the reasons that I said that increasing interest rates could have an impact on the economy, which could have an impact on stock prices. If it's in an orderly fashion that interest rates continue to go up, I think stocks will kind of outperform that headwind. We're not in the camp that we're going to have significantly high returns from stocks. As most of you guys know, being the fact that we've gone through the financial plans, you can see that we reduced our future expectation from stock for stock returns. A lot of this is kind of in those numbers, but I also don't think that we're going to be going into recession anytime soon. So 5 to 7% stock returns. The 10-year Treasury maybe goes to 4%. 3.5% by the end of the year, maybe 4% from a year from now, and maybe that makes mortgage rates about 5% by the end of the year, the 30-year mortgage, and maybe 5.5% by this time next year. But remember, it wasn't too long ago that 5.5% mortgages, people would have been stoked with 5.5% mortgages. It's just in the last 10 years that 4% has become the new 5% when it comes to 30-year mortgages. Like, okay, can you get under 4%? You're like, oh, that's awesome. But folks who have houses have really already refinanced, and so it's just going to be the folks who are either upgrading or downgrading houses, new home buyers, and I think incomes that have gone up, and if we see them go up even further, that can help. You already saw my slide on home affordability, and even with these increased interest rates, home affordability is still very, very good. That's with prices going up on homes, and that's with interest rates going up on homes, but it's also with incomes going up. So everything's kind of stayed in balance, but that definitely is one of the concerns is if interest rates go up too fast, could it be too much of a headwind for stocks? And that's really the biggest challenge for us, and that's why we're so concerned with what the Fed's doing, and that's why one of the first things I do every single morning is look at the 10-year Treasury and what is the 10-year Treasury doing. I can usually tell you what the market's doing without even looking at the market, with looking at what the 10-year Treasury is doing.
I can attest to that. Hey, that's all the questions we have for now. Obviously, if anyone thinks of a follow-up question or just anything else after we conclude the webinar, just email us. We're always happy to chat, and we're here to answer any questions. And with that, I think I'll just turn it back over to Sean here and see if he has any concluding remarks.
I'll just say that try and keep the news to a minimum. There's a lot of noise out there, but the fundamentals still look strong. In fact, they look stronger than they have in the past because of some of the price drops and the revisions to the earnings. So don't get flustered with too many of the short-term noise that's out there, and we will talk about all of that in our next quarterly insight, which will be in August. So I hope to see you all join in the August call. With that, I'll say good night, and we'll talk soon.